Geez, okay, I was not expecting this one. The Bank of Canada just gave their final and most critical speech of the year, and I watch a whole heck of a lot of these speeches and press conferences, and this one was by far the most revealing speech I have heard by the Bank of Canada. That's because for the first time in my knowledge, they're admitting that, hey, we got a lot of things wrong, and they also point to a major structural change that they're seeing happen over the next couple of years, and in fact has already happened in Canada that could put us in a whole new era that impacts how much Canadians make and how much they have to pay for things, and they also end with a warning of the risks that could be ahead and what they might do if there's a worst case scenario. So let's jump right into it. I've compiled the most impactful clips from this hour-long speech so that you can get the general idea. And if you haven't already, make sure to subscribe to the channel so you can keep on getting financial updates just like this.
Last week, we raised our policy interest rate by 50 basis points to 4.25%. This is our 7th consecutive increase since we began raising interest rates in March to fight inflation. The adjustment will not be easy, but restoring price stability is the most important thing we can do to improve the economic and financial well-being of Canadians.
He starts by setting the stage saying we've seen interest rates rise dramatically here, approximately 1,600%, going from 0.25 back in February all the way up to 4.25 where they're at today. Of course, the main point of this is to try to fight inflation, getting people to spend less money in the economy because rates are so high, trying to bring down the demand in the economy and as a result bring down inflation. But of course, we wouldn't need to raise interest rates so quickly if, well, inflation stayed down where it was supposed to. So he comes with a couple points here saying, hey, this is why we kind of screwed up here and let inflation go a bit too far.
A year ago, the economy was getting closer to capacity, but we were still coping with new waves of COVID-19. Unemployment was a percentage point higher than it is now. Supply chain disruptions combined with strong global demand for goods had driven total CPI inflation up to 4.7%. But service price inflation remained relatively low, and inflation was not broad-based. At that time, we expected supply issues to gradually resolve and inflation to come down to close to our 2% target by the end of 2022.
So he says looking a year ago, inflation was only at 4.25%, and they didn't believe that this was going to last for the long term, thinking that this was largely due to supply chain interruptions, the war that was going on in Ukraine, as well as policies out of China, these general supply issues that were the cause of this 4.25% inflation. They thought that that would get resolved and that we could just move on. So back then, because of this global issue, goods that we consume in the economy, well, those were going up in price because it was more expensive to get them because of these interruptions. But at the very same time, services, the face-to-face services that you need to hire someone to come do something at your house or something like this, those prices weren't inflating at the same pace. And that might have been due to the fact that we were still dealing with the pandemic at that time, with lockdowns seeming like they could come back at any moment. They were hesitant to bring up interest rates early because they said, hey, we might need to continue stimulating the economy if we go into just another shutdown here. But now finally it seems like the Bank of Canada is turning that finger back towards itself, saying, hey, we might have had a part to play here as well. It wasn't just a global thing.
It was impossible to foresee all these developments, but it is too convenient to write off the high inflation of 2022 as just bad luck. We need to reflect on what we've learned. With hindsight, the monetary and fiscal policy tools that were used to stabilize the economy worked effectively to support demand, but we underestimated supply challenges.
They're saying there were some issues with the policy decisions that they made, and it may have contributed to the inflation that we're seeing here. Of course, as a quick reminder, the policy decisions that they made was at the beginning of the pandemic, they lowered interest rates to the lowest they had ever been, actually the lowest they can go, to 0.25%. Now, on top of that, they also participated in quantitative easing, which added a lot of new money into the system. And finally, they gave exceptional forward guidance, essentially telling Canadians that interest rates would be low for a long time so that they would go out and purchase more with the sort of safety net that the banks were going to keep rates low. But they say that there are specific reasons that they made mistakes with the policy decisions that they made, and they break it down into 3 different categories. The first one is that supply chains are hard.
And when they're working, we take them for granted. But the pandemic reminded us that a chain is only as strong as its weakest link. With the waves of the virus hitting different parts of the world at different times, supply and demand could not recover in tandem. Moreover, the large shift in demand during the pandemic towards goods and away from services put even more pressure on clogged supply chains. Businesses couldn't meet customer demand, and prices for goods rose sharply.
So he says that their policy decisions, their interest rates, and their quantitative easing has a big impact on demand in the economy, but it can't do all that much to either lower or increase supply, right? That is largely dependent on supply chains, and if there's a blockage somewhere along that supply chain, you just can't get your good and it's going to be more expensive. The Bank of Canada doesn't have as much influence over to the supply side, and it will take a lot longer for them to work on that supply side than it was to just like increase demand by lowering interest rates. Now, they do say that there is a second reason that they might have gotten things a little bit wrong, and that is that the way that they were measuring things, well, it didn't give them as much insight as they would like.
Averages can obscure inflationary pressures. We need a more granular understanding of the balance between demand and supply when the forces driving demand diverge dramatically across sectors. Public health measures restricted the demand for services. At the same time, other parts of the economy were experiencing excess demand as consumers bought goods to replace the services they couldn't get. But the inflationary impact of excess demand for goods was larger than the disinflationary forces in close contact services. As a result, our inflation models that focus on the average or aggregate imbalance between demand and supply in the economy had a hard time predicting the rise in inflation.
So when they're predicting what inflation is going to be in the future, back when it was 4%, they said, hey, it's probably not going to be all that bad. And they're saying that was because their model was wrong or just not accurate enough to account for the unique circumstances. You see, he's saying that there were two different kind of economies going on at the same time. We had one for goods where we had these supply chain issues and prices were going up dramatically. And then we had services where actually prices were deflating a little bit. There was less demand for that because people couldn't be face to face during the pandemic, and they thought that that would kind of even out and we wouldn't see long-term inflation, but they were wrong. They're saying that services didn't deflate as much as goods inflated, and as a result they were way off with their inflation calculations. And the third and final thing that they point to as the reason why they got some of these policy decisions wrong, or at least mistimed them, was that, well, they have never actually seen a situation like this since they've begun tracking where inflation is and targeting that 2% inflation mark. I'll explain just after this.
Since we started inflation targeting in the early 1990s, we have not been hit by large negative supply shocks at the same time as our economy was overheating. The lesson from 2022 is that even if longer-term inflation expectations are well anchored, when the economy is in excess demand, businesses raise prices more quickly and buy more when their costs increase.
He's saying that we've just never seen a situation like this before since the Bank of Canada started trying to keep inflation at 2%. And the sort of two things that go into this situation is the first, seeing an economy that is in excess demand, meaning people are spending a bunch of money. Maybe they've got extra funds from over the pandemic and that they weren't able to spend, and they're spending it more quickly, and the labor market's tight. So that's one situation on the demand side. But at the very same time, he's saying we've never seen that in conjunction or at the same time as we've seen these supply shocks. Think of it this way. Imagine that each one of these circles is a car that you want to purchase. And of course, these prices are not realistic. They're ranging from $1 to $5. If we have an increase of demand while the supply is large like this, well, then these will get eaten up as people purchase them. And maybe they'll get eaten up more quickly. More people will purchase, and this rate will expand and go faster and faster. But we're still only going up in terms of price, only marginally, right? But think of it a little bit differently if we have less supply. We don't have as much supply and all of this stock in the car market, just for this example, gets deleted, while all of a sudden we can be going at the same pace in terms of the demand increase, but prices can be going up far more drastically because there is, well, simply less supply. So he's saying we've never had a time with so much demand happening all at the same time when we have such a small supply, so as a result, prices went up way more quickly than we thought they would. So these are some of the reasons that he's giving for how they let inflation get so out of hand, and we're going to get to what they're going to do about it in the long run and how it could impact you directly, but first I have to tell you something pretty wild. You see, the Bank of Canada doesn't just think that this inflation pressure is going to last only for a little while, they think that we could be entering an entire new era where there is consistent inflationary pressures caused by two main things. The first one, demographics, and the second one, reshoring.
Over the 2 decades up to 2020, a number of forces have helped keep inflation low. A stable global landscape combined with a broad consensus for free trade encouraged investment and supported productivity. Technological advancements also lifted productivity, shrank distances, and lowered costs. The entry into the global trade system of vast new labor markets in China and Eastern Europe pushed down the prices for many goods. Global supply chains grew rapidly, minimizing costs by linking the global economy through heightened specialization and trade. These supply developments all fostered a period of solid growth, low inflation, and low interest rates.
He's talking a lot about the pre-COVID era here, where we were in an era of globalization, right? Costs of goods were going down relatively. When you look at the way that the labor market opened up in China, we were able to get goods manufactured in China and as a result buy them for far cheaper. This kept prices down. At the very same time, companies were setting up very vast and very fast supply chains, but those supply chains were quite fragile, and we're going to get to that in a second. But because of these hyper-efficient supply chains and cheap labor, we were able to get goods for far cheaper than we otherwise would have. Think of what a TV costed 25 years ago if you wanted to get a 50-inch TV versus what a 50-inch TV costs now. Even though we've had inflation, the TV is less expensive now than it was 20 years ago. That's an example of this globalization effect.
These supply developments all fostered a period of solid growth, low inflation, and low interest rates. But these forces are shifting. The failure to adequately share the benefits of growth have fueled populism that is causing countries to turn inward. Support for globalization is stalling or even reversing, and productivity growth is trending down.
All of that growth that we experienced over the last 20 and 30 years, while it wasn't experienced equally by everybody, some people, large corporations, CEOs, generated a lot of wealth from that, but that wealth wasn't distributed equally across society, leading to more political unrest. And that political unrest, paired with the way that we saw supply chains break down during the pandemic, meant that people were more incentivized to think about reshoring their manufacturing, saying, oh, let's buy things that are only built in America, or buy things that are only built in Canada. Now, there are pros to that, but the con to that is that, well, it's going to be a lot more expensive because instead of paying for Chinese labor, we're paying Canadian labor, and you're going to have to pay a lot more for that, right? Costs are going to go up. But it's not just labor and reshoring or shrinking of global trade that's impacting higher prices. Well, there's another big problem that is almost entirely unavoidable, and that is the aging, shrinking population.
As the growth in the working age population slows and businesses find it harder to hire workers, there could be persistent upward pressure on wages. If higher wage costs are not matched by improvements in productivity, the cost of production will increase. The more we invest in increasing supply through trade, automation, innovation, training, and immigration, the faster the Canadian economy can grow without creating inflationary pressures.
We're in a unique position in Canada right now. The average birth rate per couple is 1.4. So on average, for every 2 people, the next generation only has 1.4 people. This might not seem a lot, but this demographic shift can lead to a rapidly aging population with not as many people coming in to fill the positions that the aging population had. This could mean that the labor tightness in Canada, or the inability for businesses to hire people, and as a result them needing to raise wages to attract more workers, this could be more long-term than we thought, and that upward wage growth means that there's more money to spend in the economy, right, on those businesses that then need to go and pay more to their employees to get them to work, and it can create this wage price spiral that the Bank of Canada often talks about. And he says the only way out of this is to, 1, increase immigration, which we're seeing in Canada, a target of 500,000 100,000 new Canadians each and every year over the next 3 years, as well as automation and innovation. Automation sort of moving the jobs that some Canadians would fill into automated roles so that those Canadians that won't be able to fill those roles anymore because of the smaller population, well, they can work higher up the stack, maybe servicing those automation machines or whatever the automation is that's helping the business sort of have less roles available. But let's read between the lines here a little bit when it comes to what the Bank of Canada is saying. They're saying, okay, we've got this demographic challenge, an aging population, and we've also got less ability for global trade, more reshoring, and both of those things are going to drive up inflationary pressures. So if they think that this could be more long-term, does that mean that the Bank of Canada will keep interest rates higher than they have been over the past 30 years for a longer time because they don't think that this inflationary pressure is going to go anywhere? So what does that mean for interest rates?
We're trying to balance the risks of over and under tightening monetary policy. If we raise rates too much, we could drive the economy into an unnecessarily painful recession and undershoot the inflation target. If we don't raise them enough, inflation will remain elevated, and households and businesses will come to expect persistently high inflation. With inflation running well above target, this is the greater risk.
Raising rates too much or raising rates too little both have very negative consequences. If you raise rates too high, we go into a recession, very little growth in the economy. But if you don't raise rates enough, well, inflation could remain high for the long term. And that is what the Bank of Canada is terrified of. They don't want inflation to run hot for the long term because then Canadians like you and me, well, we start expecting long-term inflation. And when we expect that prices are going to be higher tomorrow than they are today, we go out and we buy today because things are going to be more expensive tomorrow. That added demand in the now means that prices increase even more quickly, and the Bank of Canada is saying that, hey, if this happens, we're going to have to keep rates even higher than they are today and keep going, and there's going to be more pain in the economy.
If the inflationary forces going forward are stronger than we expect, we will start to see inflation coming in above our forecasts, and we will adjust our policy settings to achieve the 2% target. We know the adjustment is difficult, but it will be worth it. Our monetary policy is working, and once we get through this adjustment, our economy can grow healthily with low inflation. That's what lies ahead if we follow through. Our resolution is simple, and our resolve is absolute. We will restore price stability for all Canadians. Thank you very much.
So there's nothing that could make the Bank of Canada stop until they get inflation down to that 2% rate. But with that said, there's going to be a lot of sacrifices, and it could be individuals in Canada that are going to pay the price of this decision by the Bank of Canada. I think of people who bought houses at the top. I'm not talking about investors that own lots of properties, but maybe there's family that thought that they need to get into the housing market before it took away from them forever, and they've bought, and prices have gone down here as a result of the Bank of Canada's action. And they're seeing far higher interest rates, meaning they're really in a pinch right now. On top of this, higher interest rates for the long term could mean that workers lose jobs. This is what's expected to come over the next 6 months. Because there's such high interest rates, we are going to see unemployment numbers rise, more people out of work, and at the very same time, this means that it's harder for businesses to grow in Canada because, well, interest rates are so high, they can't borrow as much to grow their operations. This makes it harder for small businesses to thrive in Canada over the next potential couple of years. And even though there are serious consequences to the Bank of Canada's actions, well, there aren't really any repercussions or any accountability for the Bank of Canada here. It's true that central banks all around the world have made similar mistakes. Nobody got out of this unscathed, but at the very same time, it's the workers, the homeowners, the small business owners that are paying the price for the Bank of Canada's actions here. And it's important to note that central bankers aren't elected, and in some ways this is for good reason, right? It's so that they can take a long-term approach and not pander to the individual interests of their voters, make decisions for the long term that's best for Canada. But at the very same time, the way that they handled the financial climate over the past couple of years has had some serious impacts, and it's hurt people, and it feels like there should be some sort of consequence here, but I just don't know what it's going to be. Maybe you have some ideas. I'm curious what you think about it all. Let me know down in the comments. We went over a lot today. Let me know what you think. I read every single one and I try to get back to a bunch of them. If you haven't already subscribed, make sure to subscribe to the channel. It takes a bunch of work to put together all the research for these videos, and a subscribe is a simple way to help the channel grow, and I appreciate that. But with all of that said, thanks so much for watching, everybody. I really hope this video has helped you out at least a little bit, and I'll see you next time.